Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is your host, Steve Meisinger, with the ISE webinar series where we get together every week. In fact, this is a special edition, as we normally do these on Tuesdays, but this is indeed a special edition where we have Jack Crooks with us. And Jack will be with us each and every Tuesday here in May, where Jack will be talking about various subjects related to the currency market and what's going on with the U.S. dollar. Today, he'll be talking about spotting longer-term trends in the currency market and using FX options to ride those trends. Jack's the founder of Black Swan. He runs an investment advisory service related to currency options. He has this really interesting newsletter that he puts out every morning, and he'll talk more about that. I think you're going to find him extremely interesting. Jack really understands capital flows, what's happening with the various currencies. I think that you all will really enjoy it today. So without further ado, I want to introduce Jack Crooks, founder of Black Swan. Hey, Jack, how are you?
Hey, Steve. Fine. Thank you very much. I appreciate it. So I guess I'll get started here.
I just want to go through the disclaimer, and then we're going to run through your slides. Just so everybody knows, obviously anything we talk about today, as far as any of the examples, will not include taxes, margin, or commission. And you really should get a copy of the characteristics and risks of standardized options. You can get that at 1-888 options. Obviously, anytime you're making any of these trades, they're, of course, your decision, so you really need to think about that. But I think you're really going to enjoy Jack. Jack has some really interesting insights into the currency market. So, Jack, why don't you take it away?
Thanks, Steve. I appreciate it. In this topic today of how to spot long-term trends, there's really a lot of ways to skin this cat, so to speak. I don't use that phrase too much because I do like cats, but needless to say, there's a lot of ways to attack this. And one of the ways that we go about looking for long-term trends is really thinking about it and trying to use some logic flow because of the premises, our basic premises we have about the currency markets and the global financial markets. So what I'm going to present today is really not a whiz-bang holy grail. It's more just a thought process, and I think some key premises that we lay out that I think you can take and bank on. These are premises that we've used before and found that they hold up. They hold up over time, and needless to say, we can be as wrong as anybody else. But we're wrong not because of our premise, but because of the way we analyze the data and the way it's played out. And I'll get to that. So I just want to say that this is our thought process on how we're thinking about what's going on in the global macroeconomy and why our view in the dollar is what it is. And hopefully, instead of just taking away a technique here, hopefully you can see some kind of thought process here, some type of thought process developing, and something that you can use on your own to take away. Before we get started, again, I showed this chart a lot, and I think it's important to look at this chart. This is a chart of the U.S. dollar index, the black line, going back to 1971. There's a lot of moving parts here in this chart, but there's a few key points that I want to make, and I think if you just understand this long-term perspective, it'll help you just kind of step back and get a feel for how currency markets move in these long waves or these long trends that are driven by major global macro events. The currency market, as we know it, actually started in 1971. So if you compare that to the trading in stocks and bonds, you can see this is a very, very new market. And the reason it started back in 1971 is because the U.S. went off the gold standard then. Nixon took us off the gold standard. And at that point, all the major currencies in the world started to float against one another. You've heard this term, free float. It simply means at that point, instead of governments setting rates for currencies currencies started trading on pure supply and demand. The major currencies in the world traded on supply and demand. So if a person overseas wanted to buy dollars, he would buy dollars. As demand for dollars went up, the price of the dollar tended to go up relative to the supply. So it became a supply and demand equation from 1971, 1972 on. And the other points, as I said, I made on this chart is obviously and usually with the gift of hindsight, put on some key global macro events that you can see were drivers here. Obviously, the first event was the U.S. went off the gold standard, and it went off the gold standard for a reason. The U.S. fiscal position was slipping in the world. We were spending all kinds of money. Sounds familiar, I know, in the Great Society. We had the Vietnam War. We had all kinds of problems. Gold was draining out of Fort Knox. Players around the world that could exchange their dollars for gold were doing that because they knew the dollar really couldn't support the price of where it is relative to the dollar. So when we abandoned the gold standard, sure enough, the dollar went into a nasty 7-year bear market. And then, as if you're old enough to remember, and I am, the 20% interest rates we had in the early 80s, thanks to Volcker, because he was trying to, Fed Chairman Volcker came in, pushed interest rates up to 20% to squeeze the massive inflation we had in the 70s out of the U.S. economy. The dollar rocketed into a major bull market from 78, 79. You could say maybe bottomed in 80 up there through 1985. Then the dollar came rocketing down again in another 7-year bear market, and the main trigger there was what's called the Plaza Accord. At this point, the players around the world got together and said, hey, the dollar's too high. But really what they were saying was, at that point in time, the Japanese yen was too low. Japanese were blowing and going and acquiring things all over the world. Again, sounds a little familiar with China in that place now. So what they did, they pushed down the major currencies relative to the value of the yen with the Plaza Accord. Then when dollar bottomed again and rallied for another 10 years from around 1990 through 2000, and that was driven by the U.S. stock market. That was a major boom in the U.S. tech market. Everybody wanted to get money into the U.S. So again, these are major global macro events that have been drivers. Tech bubble broke, and then we went into a 7-year bear market in the dollar, and I call that 7-year bear market phase the implicit weak dollar policy phase. And I'll show you a chart in this presentation that explains it a little more. The U.S. dollar, and again, and I'll get to this in the next slide, is the world reserve currency. Because it's the world reserve currency, the more supply of dollars out in the world, the better off all global markets are. The U.S. dollar is the elixir that pumps up global asset markets, all asset markets around the world. So during that bear market phase for the U.S. dollar, we had a massive investment mania around the world because the supply of dollars around the world was massive. And that dollar going down for 7 years, the implicit weak dollar policy to stimulate all these global asset markets, which were driven ultimately by U.S. consumption based on low interest rates, they go hand in hand. Sure enough, the game changed because of the credit crunch, and we definitely think that is the game changer. We think the credit crunch now is the key global macro event that has launched the dollar in a multi-year bull market. A lot of people disagree with us. A lot of people say that what we've seen in the dollar is simply a risk aversion bounce, meaning people running into the dollar to hide. And the reality is they may be right. We don't know, again, unless we have the gift of hindsight, whether or not this is the major bull market, but we think it is. We think this is the major market event that has really changed the structure of the global economy, and it's going to be very beneficial in yearly terms for the dollar, not just quarters or months, as people say. And I'll explain why.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.